to show you what you will see, right, in the offering memorandum when you're getting ready to invest. So we'll get started. First, here are some of the key components. When you look at an syndication offering memorandum, these are the key parts. They may be in different orders. They may be slightly different, in terms of like the terminologies or word uses, but those are the key things. So I'm gonna go over this list. Disclaimer, basically, this is like all your legal terms, and like everything else, they, like, okay, you need to do your own research. The investment has risk, this sort of language. You're gonna get an introduction of the team and a little bit about their background and their credentials. Then an executive summary of the investment, a high level overview of like why this is a good, attractive a project, and go into more detail, property and market overview. It really, in this section, you'll see a lot of the numbers, like trends and numbers, population, job, rent increase, this sort of things. And of course, the business plan, how we are going to make money, right? And then you'll see something like a comparable, compare this particular property with like the nearby or the identical property on the market. And of course, talk about the returns and the next steps, if questions and contacts. So we're gonna go through this every sections and give you a walkthrough of what you should see on the offering memorandum. Okay, so we are doing a sample deal. So this is a fictitious deal. Just to so this is not real, so it's not a real offering, just FYI. So Amber Ridge Park Apartments. Okay, first of all, this is a 506B offering. Can anybody tell me, if you remember from a few weeks ago, what does that mean? What is 506B? Like, who can invest in a 506B offering?
If I remember correctly, I think it's the accredited investors.
Accredited?
Yeah, or is it the 506C where accredited are allowed? I don't remember.
Yeah, so okay, all right, Jesse got it. Sorry, Erica. Sorry, Ash. So it is 506B is non-accredited, meaning that anybody can invest, right? But what is the catch though? Like, what is the catch there? Okay, so the catch is because it is a 506B, this offering cannot be marketed publicly, right? So like we cannot do advertising, we cannot share this in the public forum. So in order to gain insight, you have to have a pre-existing relationship with the sponsor. So this is how you will know, right? That's how you get informed on the deals coming. So this is this is 506B. So whereas 506C, this is where you're gonna see people maybe posting it in social media. They maybe have a website. It's a public offering. Okay. Jesse, your question, 50 limited. So far as the amount, it really is deal dependent. It's up to the sponsor to set the minimum. So typically you'll see it's 50 limit minimum, and then going up from there. Okay. All right. So this is the disclaimer, right? This is all your legal terms, and they're gonna tell you we cannot be responsible for this and that, and the investment involve risk. I underline, some of the language here just for you to see. I know typically, people don't read this in detail or word by word, but you do need to know that every investment has risk, right? So make sure you do your own research and due diligence to make sure it is the right fit for you. Same on financial, but the same thing, the disclaimer. Okay, so like typically in the next section, you're gonna see the sponsor team. So in the sponsor team, usually you're gonna see basically the general partners and sometimes you'll see like the asset managers and some other additional team members here, but typically these are the general partners, is the operator. This group of people are going to be basically, they are gonna take this deal from start to finish. So the process starts from deal sourcing, right? Deal sourcing, underwriting, to lead the acquisition. This means the marketing, the capital raise, to develop the business plan, executing sponsor team. And you may or may not see this on the offering memorandum, is the key principal. So this person is the loan sponsor or the loan guarantor. So like everything else, right? Like you need somebody with certain net worth to guarantee the loan. So there's always a loan sponsor, but this person may or may not be out in the public. Okay, following the sponsor team. And then you will see an executive summary, which is a high level overview of the project. So on this page or the slide or the next few slides, you're gonna see like numbers like purchase number, how much capital raise very attractive reason for some people that really need to reduce their taxes. So usually the sponsor team will kind of like go into that in detail, talk about cost segregation and the tax benefit of the project.
Hey, Lupe, you cut out a little bit and it looks like some of us heard you cut out, but some of us didn't. So if you could maybe back up a bit when you were just talking about the executive summary. And I actually put something else in the chat from the previous slide, just so folks are aware. The key sponsor has to have a net worth equal to the loan amount. So that's another thing that's part of the sponsor team that you must have. But if you could just kind of start back over, if you don't mind. Sorry for those who have to listen again.
Okay, sorry about that. So the executive summary basically is just give you a high level overview of the project, including the purchase price, the amount is being raised, the size of the property, some of the return projections, hold time. And so I was talking about the cost segregation and why it is important, because a lot of people invest in real estate purely for the tax benefit, especially if you have rental incomes or passive income that you really want to offset, or if you sold the property this year or last year, depends on the tax year, right? Like you want to be able to offset some of that taxes. So cost segregation is a great way to do it. So one of the biggest benefit in commercial property is that we are able to accelerate the depreciation. So typically you have 27 years for a residential property, and then you can't really depreciate it, right? So you're just gonna take like 1/27th of it every year until 27 years. But in commercial real estate, we can accelerate the depreciation. So in the first year, usually is the year you're gonna get the biggest write-off, typically around 50% of your investment. So whatever it is, like if you invested 100K, you're looking at 40 to 50K of tax write-off on that. So does anybody have any questions there? Okay. And
Quick
okay, so
question.
yeah.
So can you tell us about the key sponsor? I mean, can they use their 401k as, you know, as a funding, or is 401k not allowed?
And the key sponsor, huh?
So with the key sponsor, it's looking at your entire net worth. So it's the properties you own outside of your primary residence and any sort of investments in cash that you have. So it would have to be equal to the loan amount. So it's going to look at your total financial picture when you go to qualify for it.
So will that be that, you know, 401k is allowed? I mean, whatever investments you've made in your 401k. So I have some significant amounts, but it's in my 401k, right? And so it's locked up in my 401k. That's why I'm very curious to know what happens in with the 401k.
Yes, you will put down your 401k amounts on the net worth statement.
Correct.
Okay. All right.
That could be utilized.
Thank you.
Ash, typically on this large commercial properties, I think it's very rarely people qualify based on their retirement. Typically, they will qualify based on if they own a similar identical asset or bigger, really, because a lot of this property are in the tens of millions. So I think, I mean, I don't know who has the 401k at that amount, but typically it's not common. You really see it's coming from the asset side, business or real estate or things like that.
Okay.
Yeah.
Thank you.
Yeah, you're welcome. So property overview, just additional, you're probably gonna see a lot of pictures, some exterior, some interior pictures, little bit background, on the history, how many units, occupancy, this sort of things. And usually there is also a slide or a few to show you the investment highlight, basically why this is a good investment, why this is attractive. So it can be the location is great because it's close to school, it's a great neighborhood, it's close to highway. What are some of the things that happen in the area if the local government is building a park, a shopping center, economic development, any kind of growth, right? It's good. And also, of course, like the business plan, as far as like how we are able to create value in this property. So these are the things like the sponsors will highlight to just show you why this is a good, why they like this property or why this is a good investment. So I will turn over to Noel
All
on
right.
the next slide.
Yes, thank you, Lupe. So the value add plan is really crucial to that supports the business plan of the property. So I want everyone to write this down. It's the magic formula. It's NOI, which is your net operating income, divided by cap rate equals valuation. So I'll repeat that again. Net operating income divided by the cap rate equals valuation. So we're gonna talk a little bit about that. I just want everybody to jot that down because we're going to use that later on, and show you how we create value and increase the net operating income and the value of the property itself. So some of the things that we like to do when we actually have a property is, one, we'll start with the outdoor renovations. That means we want to make sure that we are making this building beautiful. We want to make sure we're having something we call the yellow golden brick road. So that means when you're touring it, you want your potential new tenant to go ahead and see the pool. You want to have the trail to go see the dog park. You want to go past and see the gym. You want to highlight all the amenities of this building and say, guess what? You need to live here because look how amazing and immaculate it looks. The landscaping from the trees, we're putting sometimes shutters on the building to give it some potential aesthetic appeal. We're also changing over the color scheme as well. For the units, we'll do upgrades from old units. In this particular building, we're sampling, there were 23 outdated units, and we're going to convert those over. And that also increases what? Your net operating income. So always keep that in mind. Pets. Remember, this is a 156 unit building. Now, you would think like maybe 50% of people have pets. It's already been kind of, really stamped since the pandemic that people were getting, all the shelters were gone. Everybody was getting a dog. So I would also increase this to maybe 75% of the people, but we'll just say 50% of this population and this sample deal has pets. And I'm going to show you again later on how we're increasing the value. Utilities. When we're doing the property, we're looking like how can we lower our operating expenses. So if everybody's on one water bill, what we like to do is a utilization plan, which is we'll try to go ahead either sub-meter the water in each unit, or we'll go ahead and do a ratio billing depending on how many people that you have in your unit itself. And then also what the key is property management. Property management is key to your success of your business plan because they are the ones that are executing. So there's always a big difference between property management and asset management. The asset managers manage the property managers and the property managers manage the building. So that's always key. Can we get next slide? So we have the unit renovation. So as I said, right now we have 23 classic units. So what we want to do here is that we're going to do some of these outdated cabinets, which you can do. Sometimes you can actually save those. In this case, we did replace these cabinets and put white shakers on. We also swapped out the white appliances for the new stainless steel, and all that adds into the clientele that we want in the building as well. So while you're doing these unit renovations for the value add, you're also changing the culture of the building as well. So you're bringing a whole new regime. And that's sometimes how we can change from a class C building to a class B building. We're changing over flooring. So we'll get rid of some of that old wood flooring, or sometimes they have that old tile, and we're replacing it with, vinyl luxury planks. And the key thing with sometimes in these like sample deals is that we want good vinyl planks. You don't really want to get anything that's under 3 millimeters. Under 3 millimeters, everybody's going to hear what you're doing upstairs. It's kind of like a stampede, if you live in below someone. So you always want to have flooring that's at least a minimum of 3 millimeters and has a pad, because that absorbs a lot of the sound when you're in your apartment buildings. So with these unit renovations, we're going to go back to that magic formula. So if these unit renovations right now, we can go ahead and say this hypothetical, we're going to keep everything round numbers, $100. So we're going to increase everything by $100. So everybody get their calculators out. I'm gonna get my calculator out. So we're going to go 156 times $100. Everyone should have got $15,600. You want to times that times 12 for the year. That's $187,200. You want to divide that by the cap rate. So we'll go 0.5 and we're going to go 0.6 for 5 and 6%. So we're going to go 0.5. What is that number? 3 million, a little over $3 million, $3.7 million. So just by raising the rents $100, and that's conservative on this sample deal, we increased the value by $3 million. And that's that's why I call it the magic formula of valuation. Does everybody understand that? There you go. Thank you, Tiffany. Put it in the chat. Great. All right. Next slide. Oh, go back. I'm sorry. I want to go ahead and continue. I didn't know we were going right into the market. So also, what you can do on these properties as well, when you have 156 units, one of the things that I love to do when we have these properties is do valet garbage pickup. When you have a big 156 unit property, that means people sometimes have to walk all the way across somewhere to where the garbage pails are. You can charge someone almost, $25 premium, sometimes 30, that guess what? You leave your trash out on this day, we're coming out to get it. Surprisingly, a lot of the dumpster companies have that ability to have it in there so it can be rolled in there. So you're not even increasing your expenses. You're again increasing your net operating income. So let's just do another hypothetical math, So we go let's say $25, and let's just say 50 of our tenants wanted valet trash pickup. So 25 times 50 is 1250. 1250 times 12 is 15,000. 15,000 times 5 cat. Oops, excuse me, not times, divided, 15,000.
Divided by.
Divided by your 5 cat, 300,000. Now remember that number, 300,000. So we had 3.744 and we got $300,000. Make sure someone jots those down. So that's just on trash. The next thing you can do also is that, remember we talked about pets. Let's just say that 70 as half, 78 people, I think it says 78, 79, 156. What it says is 78 people have dogs or cats. I've seen it where people in their units or parakeets. Guess what? They still get a pet fee here. So let's say you're doing $25. The same way. Who can tell me in the chat how much we increase right there at 78 units at $25? Can I get a drum roll? $460,000 at a 5 cat you increased. Now, look what you're doing right now. So remember that number, $460,000. Another thing that we like to do in buildings of this size is that when you have so many dogs out there, what don't you want when you have that? You don't want poop. There is a thing that you can have, it's called poo prints. Poo prints is that when someone has a dog and it's in your complex, you have them register their poop. That's what you have them do. You register their poop. So if you have poop that's in there, you take that in, they actually have to, they'll be, if they're found to be their dog, it's like I don't call it special victims. It's like CSI for dog poop. This is a real thing. It's been implemented in many buildings. And so we'll do poop pens. And we'll go ahead and we'll fine that person for their dog not being able to, curb itself and you not curbing your dog. So just remember, there's always ways to, make sure you're enforcing your dog rules and laws. And so that's how you increase your net operating income. There's other ways in this building that you can do as well is, how do you come up with the cap rate? So you'll go with the cap rate from really your brokers that is in the area, and you'll kind of you'll actually, all right, so cap rate, interest rate normally follow each other. So as the interest rates go up, cap rates go up. So right now we'll know we're at like a 6% cap rate and 5% cap rate depending on the area. But normally I always talk to the brokers and what they're seeing and what they're seeing to get that cap rate. But a quick way to kind of know is that interest rates and cap rates normally always follow each other, but they are specified per region and city that you are in. Another thing that we can do is parking lots. So what I like to do is called striking the parking lot. So when you strike the parking lot, now you are coming in with an agreement with a tow truck company that to say, hey, anybody without a decal, you have to register your car, is getting towed. And what you can do is you can offer a premium parking for, you know, certain residents. Some people want to have that premium parking. Again, just to say it's a large building, but let's say that maybe, again, 25 people want it. You know, we'll keep it around. Actually, no, I think 156 unit building, 50 people will probably want preferred parking, especially if you're coming home late. You want to just pull in right into your unit and know that your parking is secure. You know, I'm from the city, Philadelphia, you know, the Eagles, Super Bowl, you know, contending Eagles. I had to put that plug in there. You know, I hate coming home and have to, you know, travel blocks away for parking. That is one of the conveniences of being in a unit of this size and offering premium parking. So to say $50, or let's go $25 for 50 units. Who has a number for me?
Is it 300,000?
Are you sure?
Or is it 3 million? I messed up on zeros.
Let's do it. 25 times 50, 1250, 1250 times 12, 15,000. Yep, $300,000. So keep that number as well. So we have, what do we have? 300,000 for parking. Right. What do we get for the dogs, the pets?
468.
All right, plus 468,000. What did we get for a valet garbage pickup?
30,000, the 300,000, right?
Yep. And what did we get for a rental increase?
3.7 million.
Right, 3.7440. So this one time doing those things and implementing those, you increase the value of your building $4.8 million. And that's why I call it the magic formula. Remember, it's net operating income divided by the cap rate equals your valuation. And that's how you implement a value add plan for your business of your property. Any questions on that? All right. Next slide. Market overview. So Lubbock is, I would consider Lubbock, Texas is kind of a sweet little gem that's just kind of sitting down there in the north of Texas that is quickly growing. You know, looking at trends, there are people moving from California, Nevada, Oregon. You have some Midwest cities are moving to Lubbock, Texas for a number of particular reasons. You know, the population growth, income growth, the crime trends are down, job growth is up. Texas Tech, which is one of the biggest universities in the United States, is constantly growing, and they're actually their graduates. So they're retaining almost about 11,000 of their graduates per year. So Lubbock is just a really premium city that is just trending upwards. Next slide. And so here we go, the employment trends. This is what I spoke about previously. So this is 2019 to 22. even before we get to this point, we like to look back almost 10-year span and look at the trajectory of employment. But look, Texas, the state of Texas, and I guarantee you that whole state of Texas for job growth and labor force is predominantly, your three major players, Houston, Dallas, and then your number one player, Austin. But look how Lubbock comes in there at 3.5 and 4.1%. And look at the rest of the United States. Can't beat that growth. Next slide. This is reiterating the job growth. You can actually, my eyes are bad, I'm getting a little old here, so I got to get up in there. But when you're looking at the scale of the jobs that are being created, is that you have 70,000 new jobs that have been created. They're going to be created right now within 20 to 2030. Right now, Lubbock does not have enough people to employ or fill these jobs. That's a good problem to have. Really is a good problem to have. So we always need employment in Lubbock. So people are flocking there from low cost of living. And when I was down there recently, there were a lot of people working remotely in Lubbock just because the cost of living was so low. And it's such a great town. Next. Again, here's the population trend. We spoke about this briefly, but again, it's rising almost 4% every year. I believe Lubbock hit of almost a little over 300,000 people this year. By 2050, I think they're aiming to have 500,000 people out in Lubbock. Yep, thank you, Tiffany there. So the location map. So when selecting, a property of this nature, we always want to look what's in the surrounding area. So this particular property in the sample deal, what do we have here? We have quick access to major highways and roads that have access to supermarkets, gas stations, department stores. We also have, to your left, we have access to your elementary and high school that's on the side here. And so this is particularly important because within this property, these are 2 to 3 bedroom units. And when you have something that's a 2 to 3 bedroom unit, who's normally living in there? Families, people with kids. And you have to also know that Lubbock in itself, I think, was ranked 10th for best places in the whole country to raise kids with dual parents. I don't know how to come up with the statistics, but it was in the Wall Street Journal. So they have those statistics there that Lubbock is one of the best places to raise children. It's in the top 10 in the whole United States. All right. And so here we go. We do the rent comparable. And so when you have this on the side, we'll look at the rents, and you can get the rents from either a broker, a CoStar, or another CRM. And what you want to do is that you like to compare apples to apples. So we want to have something that is similar in style, date that it was built. You also want to make sure that unit size is also lining up with each other, and also the details inside. So when we're looking at our building compared to other buildings that were renovated, and we're like, man, this is a building that's like $250 under market. Well, that means that's a big upside. So just remember, we only did $100 because a building of this size, it will take at least 18 months to stabilize, at least minimum. So we're just looking at there, and then every year after that, we'll have conservative increases at 2 to 3%, until we meet that max rental income. So at that time, as we're still climbing the rent escalator year after year, guess what we're doing? The value of our property is getting higher and higher. Again, the magic formula, it works. Next slide. And here it is, sales comparable. So once you actually hit that ceiling, and right now you're at the top of the ceiling, that's normally where it tells you it's time to sell. Make sure you're giving your investors a 2 or 3x, equity multiple. Do we remember what a equity multiple is? Who can do it? Ash, come on, I know you know what the equity multiple is.
Yeah, so equity multiple, correct me if I'm wrong, isn't it because I put everything in my Excel formula, right? And I don't even think about it, but is it like, what is the return as compared to what you had put in, right? In terms of equity.
For your equity multiple?
Right?
Not exactly. Tim, do you want to put the information there and the formula? And then I'll go into it. Is it in there? So we go, I think she put it in there. I lost you guys, but I'll just go ahead and go off. Equity multiple is really defined as the total cash distribution received from the investment divided by the total equity invested. So I'll repeat that again. An equity multiple is the total cash distribution you receive from your total investment divided by, from your investment divided by your total equity invested. So for example, if you have $1 million in all cash distributions received from the project, total 2.5 million, then the equity multiple would be 2.5 million divided by $1 million. So you would have a 2.5 multiple equity multiple. Does that make sense to everyone? Or I need to read it? I know sometimes I'll talk really fast, so I'll just make sure you tell me, slow down, Noel, slow down. Tell me, simmer down. I literally lost the Zoom screen. I need to find it again.
No. I think it's very clear, Noel, and especially now that Tiffany has put in the formula. Yeah. So it's a return on investment in the true essence, right? How much you put in versus how much you're getting out of it.
Correct.
Net return,
So that's how you determine your equity multiple. All right. Next slide. Or not, we could stay on here and talk about equity multiples. All right. And then again, what I said, your key to success of your business plan is literally your property management company. Here, this is just kind of an example of what a property management company would normally kind of tell you, and the kind of expertise you want to vet to ensure that your property manager can handle, one, a building of this size, and number two, can execute your business plan. So I always tell people, when you're getting a property management company, they are there to work for you. So you tell them how you want your property to be managed, and they execute your business plan. You really have to keep a tight ship on them to make sure they are executing, because if they're not, that is really delaying your business plan, which can have really critical consequences to the overall property itself. It can impact distributions. It can impact how fast we're doing a refurb of a unit, and all that really means is we're delaying heads to beds. We want to make sure if it's an empty unit, we want heads to beds. If the property management company should always be looking to making sure we're re-upping some of the current tenants. And so when I say that for the renewals, we want to make sure we're having renewals at the higher price, especially if that tenant was good. We don't want people leaving. And the reasoning is, if we have to have a tenant leave and it was a good tenant, what happens to that unit? We have to spend extra money to get it ready, whether that's painting and things of that nature, which is an expense. But if we know how to keep the current tenant in with a renewal and just increase the rent, guess what? That's all cash flow, which is doing what? Increasing your net operating income. So we always want to have your property management aim into renewal, especially on a lot of the renovated units. I just want to make that clear. If the property hasn't been, that means that unit has not been renovated, then that's okay. Let's get them out of there. But if that's a good tenant, we want to move them into a newer unit at the higher premium, and then get that older unit up and running and get another great tenant in at that higher premium. Is that clear for everybody? Good, good. And next up is Tiffany.
All right.
So I have a quick question, Tiffany.
Sure.
So how often, like, at the beginning, right, when when we start, how often are we in touch with the property management team? On a daily basis at the beginning for the first year, because that's the most critical of the 5 years, right? So, or is it like, a weekly plan, or how does it work? What has worked best for Noel and you guys?
You should be on a weekly basis, but I would say it's all contingent on what type of property you purchase. If you purchase a A-class property, maybe you're already at a top of a ceiling, so it's already a fine tune running machine. But if you're in a C class and you're trying to go ahead and move that to a B class, you need to be meeting with your property manager on the regular, maybe a few times a week, especially when you actually get the building the first time. You should always be implementing, when you get a building, a 30-day plan, a 60-day plan, 90-day plan, and 180-day plan that has certain criteria and bullets. And we'll dive deep into that when we actually give our asset management webinar and on asset management, on what those bullets are for each of those milestone days and how you're transitioning ownership and property management. Because remember, it's going to be two new, entities that your building will have. You'll have a new property management company, and then you'll have new asset managers as the owners.
Thank you.
Definitely. And I mean, it would be a minimum weekly for sure. All right. So now we'll go ahead into the fun part, return summary. We're all trying to make money here.
What's the money, Tiffany? Show us the money.
All right. Next slide, please. All right, so whenever you're going through an offering memorandum, this is something that you should see here. It basically breaks down where all of the money being raised is going. So you'll see where the down payment is going, how much the acquisition fee is, if there's a guarantor fee, how much that is, the loan points, the closing costs, the renovation costs, the taxes and insurance reserves, your total acquisition cost, and then any sort of sponsor co-investment as well. So that way you're able to see exactly where every dollar that's being raised is actually going. Next slide. You'll also see a snapshot of a pro forma within the offering as well. This will basically give you an overview on your potential income and kind of like where the property is, then the to-be state. So that way you'll really get to see how the business plan and the numbers align. The value add piece, you'll slowly see it coming into play over the years. If there's any sort of refinance in the property, you'll also notice, for example, many times the cash flow may dip after the refinance. And the reason for the dip could be twofold. It could be that now you're actually paying, instead of an interest only loan, you're paying for the interest and the principal. So those are things that you'll notice in the pro forma. It'll pretty much break down any sort of loss to lease, what your potential rent's going to be, all of the expenses. And you'll notice in the expenses there, you'll see everything from your taxes and insurance to your contract services, to the payrolls, the property management fees. But essentially, this is giving you an overview of where the dollars are being spent, where the money is being earned, and essentially how you're getting paid. Next slide. And here's the projected equity at sale. And this is something that Noel touched on a bit when he was going over the valuation of apartments. As we know, it's net operating income divided by the cap rate. And you'll notice that slight differences in the cap rate make very large differences when it comes to the actual valuation. So whenever you're reviewing a deal, you should be provided with several scenarios at sale. And when I say several scenarios, because there could be a change in the cap rate. Whenever we're looking at deals in our underwriting, we always increase the cap rate at sale just to reside on the side of being conservative. And here you'll notice that the projected equity at sale is actually 3 different sell prices, and that would be based upon the exit cap rate. And then you'll notice just the differences in terms of sales price and essentially how much you'll get paid at the end. The goal would be to sell at a lower cap rate so that we can get the max value. Next slide. All right, so projected returns. Now, here's where you'll actually see how much money you'll be making. This here is the projected returns on a 5-year hold. So you'll notice in year 1, your cash on cash return is around 5.3%. So for a $100,000 investment, you'd receive $5,300 the first year. It goes up a little bit more the second year because typically your first year, the property is really being stabilized. Whenever you're turning over a property, there is a change sometimes in property management. Obviously, there's a change in ownership, so things have to change around and you really have to kind of stabilize the property. You have to get the non-paying tenants out, turnover units. So many times your first year is going to be the year that you will cash flow the lease because of that. Because in that year, you're really stabilizing things, and that could take some time, a few months to stabilize, and it could take up to the whole year. In year 2, you'll cash flow a little bit more there. You'll notice around 7.1%, so around $7,000 a year. Year 3, and year 4 around 7 and 7.5%. But you'll notice that in year 5, you really get the bulk of your profits and your proceeds. And the reason for that is because year 5 is the sale of the property, and that's when you receive all of your investment back along with the profits from the sale. And you'll notice here in the last column of totals, you'll see how the totals break down. So across those 5 years, you've cash flowed around $34,000. And then in terms of profit, you receive a little over $55,000 in profit. So on a $100,000 investment, your return is around $90,000, which is an average annual projected return of 18%. Are there any questions on this slide here? Doesn't look like there are any questions. Next slide. So this just breaks it down again. On an initial $100,000 investment, your total cash flow is $34,000, and your equity at sale is $55,000. And then you'll notice here, your final investment value would be a little over $190,000. Next slide. All right. So at the end of any sort of offering memorandum, you're going to have the next steps. So the next steps would actually be registering for an investor portal and making a commitment through the portal. In that portal, you're going to find your PPM, which is your private placement memorandum. It's going to go over everything that you see in this sample deal, but it's actually going to give you even more details. It's actually an agreement that an attorney has drawn up. It goes over your projected returns, the sponsorship team, where the funds are going, and you'll have to sign off on that. And then you typically either send your funds through ACH or a wire. And then that's how your spot is actually secured in the investment. And of course, you'll have a due date for the actual funds. And then the portal is what you use to actually track your investments. For example, your documents will be uploaded to the portal. There'll be pictures in the portal, your tax forms will be in the portal. So when it's time to receive that depreciation, you'll actually get your K-1 from the portal there. So that way you have a secure method of sending your funds, as well as tracking your funds and exactly where the deal is.
Tiffany, you want to jump into, for people that are not familiar with what a K-1 is, if you have not done a deal, what that is?
Sure. Your K-1 is actually going to show the amount of money invested in the deal, and it's going to show what the depreciation is. So that's what you would take your tax accountant when it's time to do your taxes, and that's how you would receive your depreciation. Noelle, did you have anything you wanted to add on to the K-1?
Nope.
Okay. Yeah, so that's how it's all tracked from a tax perspective.
So one thing about the K-1 is that just be aware, a lot of times on these large properties, it takes a lot of time to get this K-1 process, because you have to first get through like the cost segregation, right? The whole depreciation piece. That's you have like a cost segregation accountant. That's a specialized field. So they do that, and then you go to the regular accountant to get the K-1 distributed to however many investors. So it is a process. Just so be aware that you are likely to file your tax later when you have when you are in an investment like this, because it takes a lot of time to get this processed. So just from my personal experience, a couple of times I had to file the extension because of that. It can happen. Just be aware of that.
Thanks, Lupe. All right. So this is actually the end of our presentation for the sample deal. So you have our contact information here, and we're actually going to open it up for questions. So we can take down our slides and open it up. But you know what? I think I have the poll ready to go now. So we'll go ahead and launch the poll that didn't launch in the beginning. I'm going to go ahead and launch it now. And this is just a fun poll here to really, understand the audience, and it's actually real time. So as you vote, we can see what the results are. And we won't see who submitted the results, but we'll see what the results are. So the first question we have here is, what is the most important consideration when you are evaluating a deal? And there's no right or wrong answer. This is honestly your preference. So the first answer is your sponsorship team. The second is location. The third is returns. Next, do you invest based off of cash flow or equity? Next, how do you fund your investments? Is it retirement funds, cash, whole life insurance, HELOC, or other? And then what is your primary investment goal? Is it early retirement, additional retirement funds, additional income, generational wealth? So right now it looks like we only have 5 people voting. All right, now we have 7. Let's do it. Yeah, we're not going to see who's answering, but I mean, we're just curious to see where the answers lie. And again, there's no right or wrong answer when it comes to this. We'll just give it the last, let's say, 25 seconds here. So if anyone else wants to jump in and vote, you have time. All right, looks like someone else jumped in and voted, and we'll just end the poll and kind of see where everything shakes out. There's still a few seconds left here, and we only see 81% participation, but that's...
Oh, there we go. There's the 86.
All
Come
right.
on.
3.
Let's get that 90 percentile. Come on.
All right, time's up. We'll round up. It was 86%. So we'll go ahead and just share the results here. All right. So it looks like for the first question here, what is the most important consideration when you're evaluating a deal? We had 54% of the people vote sponsorship team. Location and returns came in second place. They're both tied at 23%. Do you invest based off of cash flow or equity? Okay, so cash flow came at 54% and equity at 46%. And how do you fund your investment? So it looks like most people fund with cash, that's 77%. And then other comes in second place at 46%, and then retirement funds and whole life comes in last there. What is your primary investment goal? It looks like number one is generational wealth. Yes, that's one of my goals as well. Additional income comes in second place, followed by early retirement and additional retirement funds. All right, can you scroll? Which way do you want me to scroll, Jesse? Let's see, back up. I'll just scroll back down maybe. Slowly. All right. Weird, you don't see it scrolling? Here, let's see if I can make it bigger so you can see the whole thing. How about that? Okay. All right. I am going to, okay, you can do it on your end. Perfect. I'm going to go ahead and stop sharing that poll there. That was just for fun, just to kind of switch it up a little bit and to better understand our community. But now we're going to go ahead and open it up for questions. Do you have any questions surrounding what you would see in a sample deal, or any indicators that we spoke about this evening?
So how often, I'm sure there's I'm sorry, I don't want to, like, is there anybody else? I'll wait for somebody else, and then if no one else, I can ask the question.
Go ahead, Ash.
You can go ahead, Ash.
All right, thank you. So how often do opportunities come around? I mean, I know we are always scouting for opportunities, but like, realistically, I'm just trying to, get your experience. Like, the three of you have been doing this for a longer time than any of us, right? So a realistic opportunity comes once every 6 months, once every year. I mean, how has it worked out for you guys?
I mean, there's a ton of deals out there, but I would say a deal that's going to put our investors in the best position, I would say come, few and far. So, our interest is always for our investors. So we're very, very critical of that, because you're our best asset and interest.
Yeah, and I'll actually piggyback on that. Many times the goal may be only like 3 deals a year, because it is a lot that goes into these deals, and we do like to have the deal at a stable place before closing on the next opportunity. Also, there's a lot of capital that needs to be raised, and we just want to make sure that we're fully focused and concentrated on executing the business plan as well. So I would say the goal typically is around 3 to 4 deals a year.
Thank you.
Okay, so we do have a question here in the chat. Pierre, I see that Lupe answered your question, and you can always reply to an email or call or text if you have any questions too. So for Rayfield, he asks, how do you deal with legal issues from tenants? In terms of tenants who might sue for various reasons, is there a lawyer retained by the sponsorship team? I'll pass this one to our asset manager.
So, yes, there is a lawyer retained to the asset management team, but they won't be the person interacting with the tenant. So the property management team has lawyers and can actually mitigate that issue with the tenant. So for this particular deal, or not even deal, it's a sample deal, but in Texas right now, Texas has what you have a 3-day, not a 3-day, you can, let's break it up. If there's any legal issues in Texas and that person wants to sue you, depending on what they're trying to sue you on, there is a mitigation hearing. If it's just for eviction, then the tenant has to pay their eviction fee up front. So does that make sense? So if upon moving in, those are one of the fees that the tenant has to actually prepay, which is a great thing about, I don't get into politics, but one of the good things about being in a red state.
No, absolutely. That makes sense. I appreciate that. It was just something I was thinking about, so I wanted to ask, but thank you.
So when you want to say sue, I want to make sure I'm being clarifying. There's what exactly give me an example of what they're suing for.
I was just thinking maybe in terms of wrongful eviction or something to that.
No, so if it's wrongful eviction, one, it would be hard to prove, okay. But again, Texas has very good landlord laws. So the process would be to say, for example, if the tenant did not pay their rent, and so right now this is it's the 5th of the month, and now we're on the 6th. What you can do for the tenants is ask the 3-day to either pay or vacate, and that's Texas law. You can do 3 days to pay or vacate. If they do not pay within those 3 days, then the judge will actually go ahead and send the constable, and they'll put a lock on the door. So that means they can't even get their items or anything like that. Previously, the constable will actually allow them to actually either remove some of their items, or the constables will remove their items and put it on the sidewalk. Now they're just lock them up, and it's just free will. Well, not free will, it's done.
Okay. All right. No, thank you for that clarification. It makes sense.
Definitely. And just to kind of piggyback off of the property management piece, many times, I mean, with apartment investing and larger assets such as this one, the property management company actually takes care of a lot of things, including like the construction and some of the things that on smaller units that a property management company typically wouldn't take care of.
Yeah.
All right. So we have another question here. What sources do you use to find the deals?
Oh, so that's a good one. So we'll go through right now, brokers. We have a brokers list that we'll like to we'll like to interact with the preferred brokers in that area. Excuse me, what I've learned right now is that brokers that may have been like top performing brokers that have been performing at a high level for 20 or 30 years more, they have a preferred buyer already that they have been dealing with. So what we like to do is team up with another broker that's under them, so we can always grow together. They know the criteria, what you're looking for, and you can always grow together. Another source, we do use third-party software to go direct to seller to actually look for deals. So currently, I'm evaluating a 90 unit that is in Houston, Texas. That's just, we always evaluate deals, but that is a deal that came right from one of the softwares that we utilize. We can use Reonomy as one of them, some things like that, CoStar, that you can actually use to find direct to seller. But you always want to know, the higher you go up in units, most of the times those people are only dealing with brokers. So the lower class units that you may be able to do mom and pop, but a lot of the higher class units, they're always normally directed with the broker. So broker investor relationship is extremely important. Oh, thank you. There you go. Crexy and LoopNet, yes.
I mean, if you just want to look online at properties, but many times you'll find on the commercial side, even trying to call brokers or get in contact with them, they aren't very responsive to you until you have a relationship and until you've actually closed some deals. Even when you call them, and you get them on the phone, they're going to look to see if you actually have closed on property. So it's definitely a bit more competitive on the commercial side, and definitely relationship driven. Noel actually has something called the love factor for brokers that he uses based upon a broker that wrote a book who told us about the most successful syndicators pretty much across, there we go, multi-family investors who dominate. It's by Bo Berry, really great. Bo's actually a top broker down in Florida. Really cool dude. And that book breaks down exactly like what it takes to really build these relationships and kind of raking your brokers. So it's a lot that goes into like the relationship building as well, in order to get the deals, because most of the deals that are truly deals don't hit Crexy and LoopNet. They typically will call people that they know that would be potentially interested and who could actually close on the deal before they even put together the listing for the deal, because to put together the listing sometimes can take on the commercial side anywhere from 6 to 8 weeks. So if they know they have someone who is stable and would like the property and close, and that's who they're going to give it to before even putting the package together. But we do have another question here. That's based off an example of failure of the client to pay. What about property owner's breach of contract?
What can you get into a little bit more detail of what that breach of contract would be? Is that like saying they had no hot water or something of that nature?
Yeah, so it's kind of piggybacking on the previous questions that the gentleman asked earlier. I guess overall, like with the sponsorship team, how would the sponsorship team like litigate a situation where the client or the tenant inherently wasn't at fault, but they had legitimate grounds to proceed with the lawsuit against the property owners, and in doing so, what would that look like from the sponsorship team? How would they deal with that? How would they manage that situation? I mean, I couldn't give a specific example because I'm not too familiar with the legal standings between how Texas manages properties. But I would say in any circumstance where the sponsorship team litigator would have to address a situation that comes about as a result of the property owner failing to adhere to something to the effect that gives grounds for the tenant to pursue a suit. What kind of time frame would you expect to see some kind of resolution, or what would be involved with that process? I mean, this is a kind of an in-depth question to answer, but I felt like it was one of those, like, the way you were explaining it seemed like more so as if the client was at fault rather than the property owner.
Correct. So you got to remember that would be directly with the property management company. So as the sponsor, we would not, there's a boundary in there between there. So that's a layer. So remember, we're doing the asset management. So that means we have property management oversight. We're monitoring the income and expensive trends. We'll go ahead and oversee the renovation plans, and we'll actually oversee how the property management company are handling situations as far as legalities regarding evictions or unhappy tenants where they want to file suit. So that's that level of buffer right there. If we were self-managing, then we would be directly impacted. But now what we're having is that we put that trust right there into a property management team. And so they have their own legal team, and we'll monitor how they're handling that.
I see. So this wouldn't actually be directly correlated to the sponsorship team in any way. The sponsorship team would essentially find the appropriate property management team to help facilitate the services, and through them, the third party relationship you have with them would essentially be obligated to find a legal attorney to support that effort for management of it.
Correct. So when we're vetting property management teams, we're always asking, what type of buildings do they have at this level, who their legal team is, how many times have they been in this situation? So for a building this size, you would not go with a prima donna type of property management team or a property management team that was not kind of well established. So particularly from that excerpt that we had before, you want to look at someone that has years of experience within the industry. Kind of in Texas, the major players are RPX and Greystone are like your major property management companies within that, and they have their own teams that would manage those legalities. And you manage the property management team.
Understood. So the biggest goal would be ultimately sometimes to aim to become like build a strong sponsorship team that does its due diligence to acquire the best credible service providers or third party relationships with, be it your property management team or the I think it was mentioned the sponsor. I want to make certain it was a sponsor. I can't remember if that was, I might have that mixed up too. But ultimately to vet and find the most credible service providers that's possible, right?
Correct. That can actually handle this unit size. Yeah. So remember, we want them to manage the building in a certain fashion that for the outcome that we want for our business plan. So we're already going to ask, even before we put this building under contract, we were already going to ask and vet several property management teams to see if they're a great fit for this property.
Understood. Thank you so much.
Yeah, no problem.
All right. We also have another question in the chat. The question is, how often are distributions made? Monthly, quarterly, yearly? So for that particular question, Jesse, it's really deal specific. I will say that most often distributions are made quarterly. And sometimes in terms of when they're going to start, I have some deals that haven't started paying out, that won't pay out the first year because it's a complete reposition. So it all depends, but typically you're going to see quarterly payouts, and every now and again you may be able to see monthly, but your typical is quarterly. And Lupe, were you gonna say something? I'm sorry.
No, I was gonna. Sam, my internet's kind of cutting in and out. But there's another question from Twana. You see, have you ever needed to terminate a contract with the property management team due to lack of agreed performance? If so, how was it handled?
It was handled in a, I think contractually, you handle it like a business. You put no emotions within it. You explain to them you're not meeting the timelines or the guidelines that we set to execute the business plan. Before that is done, you already kind of have another property management team lined up, so they can already kind of take the reins. So, most of the time, if you're going to switch that over, and it does happen where you have property management teams but guess what? They're just not working out. What you would do is that on your daily calls, you may have one of the personnel from the new management company sitting on there. And so they can kind of hear what's going on and get caught up to speed of what's going on. And then you can actually make your transition. But it does happen, unfortunately.
Definitely. And I mean, with property managers, they're only as profitable as the amount of net operating income that's being brought in. So it's truly in their best interest to perform at a high level, because the better they perform, the more they're going to get paid.
Yeah, and just, I don't want to ramble, but to piggyback that, I think everyone is experiencing it in the economy with the, what do they call it, the Great Resignation. The level of quality of workers has actually decreased. What you can find. I'm sure everybody's experienced it, from restaurants, the department stores, the customer service, maybe even some of your co-workers and colleagues that you have now, and that the level of execution, professionalism has decreased post-COVID. So you have to actually really stay on top of that right now. I don't know where everybody's working at, but there's somewhere.
We
I
have
love
to make
that.
sure that that's correct. All right, do we have any other questions here? All right. Doesn't look like there are any other questions. As always, thank you so much for joining. We look forward to Thursdays and just teaching everything that we know and that we're passionate about. Noel, Lupe?
Thank you for
Uh,
coming. See you next Thursday. We're always here 7 p.m. every Thursday.
Good. Yep. Thanks for all being here. You know, I like to end with something
Thank
motivating.
you. Thank you so much. Wonderful, wonderful, wonderful presentation. Thank you.
And so tonight is moving with intention and purpose. It's been on my mind lately. And so I want to, you know, a good phrase is actually Tony Robbins says a lot, but it's actually from Eleanor Roosevelt is that if you want to take the island, you have to burn the boats. So put yourself in a point of no retreat. You know, move with intent, move with purpose, and move with your purpose, not no one, else's, sometimes you have to put some of the blinders on and make sure you're focusing on yourself and moving within that purpose and intent. Do not treat, your dreams and ambitions as a hobby. Move with purpose. So if you want to take the island, burn the boats. Thank you.
Thanks,
See you
Noel.
next Thursday. We're out.
Thank you.
Bye, guys.